This is the video on continuation patterns using Technician software. Just like an automobile heading out for a long journey, trending markets need to rest occasionally to refuel. These rest stops are called congestion zones. And a congestion zone is simply a price level where the bulls and the bears are rethinking their strategies, licking their wounds, and wondering what's going to happen next. In continuation patterns, the market rests for a while and then continues on its way in the direction of the original trend. So let's start with simple ones called a rectangle. Here we see American Express with a rectangle pattern, or in other words, just a trading range. Simply stated, it's just a region bound by a support line on the bottom and a resistance line on the top. The market trades up and down between these levels for a number of periods, and that can be days, weeks, or minutes, depending on the chart type being used. So this chart of American Express is in mid-2013. You can see it did trade up and down several times until finally smashing through the upper border towards the end of the pattern. It is important to let the market prove that the rectangle is a continuation pattern by letting it actually break out in the direction of the original trend. Rectangles and the other patterns described below break in the direction of the original trend, but not all the time. Let's move on to the other patterns. Starting with triangles. This is a type of continuation pattern that has converging lines of support and resistance. Some traders refer to triangles as coils because the trading action gets tighter and tighter until the market breaks out with great force. Again, the breakout usually, but not always, occurs in the direction of the original trend. This is a weekly chart of Walter Energy, and it's on a log scale, so the right axis does look a little strange. Here we can see a descending triangle and two flag patterns. The triangle highlighted had a very strong breakout lower. The declining price range in triangles makes buying volatility, an option strategy, a very good plan. Triangles come in several varieties, from regular symmetrical triangles to extended pennants. In the chart here, we see a descending version with a flat bottom and a falling top. The top is descending. In an ascending triangle, it's just the opposite, has a relatively flat top boundary with a rising bottom. And both of these usually point in the direction of the likely breakout, but only with a modestly greater predictive power than any other triangle. It is important to keep in mind when analyzing triangles that the breakout is significant if and only if it occurs approximately 2/3 of the way from the left side of the triangle to the apex, which is the point on the right side if the lines were extended. If price action continues to bounce around in the triangle close to the apex, a breakout is less significant, and other technical indicators should be used. Two patterns on the right are called flag patterns, and these are the most common types of continuation patterns. And they're named for looking like a flag flying on a flagpole. I know that would be more clear if this were a rising trend for this stock, but it's a falling trend. You can see the flagpole. Perhaps this is your flagpole, and then there's the flag portion. When a market is trending higher, it is more common for it to slowly give back some of those gains as bulls take profits. And of course, the opposite here, when it's trending lower, the bears are taking profits. Since traders do not do this all at the same time, the market displays a counter-trend move as more and more take their profits. When this is over, the market generally breaks out in the direction of the original trend, as the bears in this case retake their short positions and new bears enter the market at new attractive price levels. In other words, higher prices. They sold the rally in this case. For those who are historical market buffs, the intraday chart of the 1987 stock market crash showed this same pattern midday, as even that raging bear needed to rest for a while. So again, continuation patterns are basically pauses or rest stops within a trend that is about to continue in the same direction. Again, it is important to wait for that trend to actually break before taking action.